In addition to all the deductible expenses, real estate investors enjoy far more tax benefits than the typical side hustle allows. Here are some tax advantages for investment properties. Number 1. Hold business properties for more than a year. When you own something for less than a year and sell it for a profit, that profit is taxed at your normal income tax rate. One way to avoid this is to own properties for longer than a year before selling. The highest capital gain tax will be at 20% instead of the normal tax rate of 37%. If you flip houses, consider renting them for a 1-year lease term before selling them. You lower your tax rate, earn some cash flow, and may even benefit from appreciation and a higher sales price. Number 2. Avoid paying double FICA taxes. If the IRS classifies you as a dealer rather than an investor, you're considered self-employed and owe double FICA taxes. FICA taxes are employment taxes designed to fund Social Security and Medicare. They're split between employers and employees, with each party paying 7.65%. If you're self-employed, you owe both, for a total of 15.3% in addition to your federal, state, and local income taxes. Anyone who flips houses should form a strategy to avoid dealer classification by the IRS and thereby avoid the extra 15.3% tax. One way to avoid dealer status is to demonstrate investment intent for the profits of each sale. In other words, build a case that you don't sell properties as part of your regular business practice, but to generate capital for other investment projects. These other investment projects could include paying for improvements to another property or making a down payment on a long-term rental investment property. Another strategy is to avoid doing business through a single-member LLC, which is typically disregarded for tax purposes. Instead, you can create a legal entity such as a partnership LLC or S corporation that changes how investors are taxed. Talk to an accountant with plenty of experience working with real estate investors if you plan on flipping more than a couple of properties each year. Number 3. Live in the property for 2 years. Ever thought about doing a live and flip? You move in and over time make improvements and upgrades? If you live in the property for at least 2 years, the first $250,000 of capital gains is tax-free for singles. For married couples, the limit is a full $500,000. Of course, you may not want to move every 2 years, but if you love home improvements and tinkering around the house, it can be a fun way to earn money tax-free. Number 4. Defer taxes with a 1031 exchange. A like-kind exchange, according to Section 1031 of the Tax Code, allows property owners to defer paying taxes indefinitely by buying a similar property with their proceeds. It works like this. Say you buy a property for $100,000, spend another $20,000 on improvements, and sell it for $320,000 for a $200,000 profit. You could pay income taxes on the $200,000 profit, or you could reinvest $320,000 in another property without paying any taxes. Number 5. Do an installment sale. Say you sell a property for a $200,000 profit. For whatever reason, you don't want to do a 1031 exchange to buy a new property right away. If you file your tax return with an extra $200,000 in taxable income in a single year, you can expect to pay some hefty taxes on it, which may well push you into a higher tax bracket. Alternatively, you could spread the profit over many years by offering seller financing. In the year that you sell the property, you only have to pay income taxes on whatever down payment and the principal the buyer pays you. Over time, they gradually pay down the balance they owe you, month by month and year by year. To make matters even better, you get to charge the buyer interest. The risk, of course, is that if they default, you have to foreclose on the property. Don't enter an installment sale lightly, and make sure you thoroughly qualify the buyer. One option is to start with a lease purchase agreement, wherein the buyer starts as a renter with part of their rent going towards their down payment each month. At a certain down payment balance, you can then transfer the property to the tenant buyer and sign a mortgage note and lien. Number 6. Maximize your deductions. One of the advantages of real estate investing is that every real expense and some paper expenses are tax deductible. You can deduct mortgage interest, insurance, property taxes, maintenance costs, property management fees, advertising expenses, software, tools, or other real estate support expenses, legal fees, closing costs such as title company and lender fees, home office expenses, travel and mileage expenses, pass-through deduction, and depreciation. The best part? You can still take standard deduction. Most of these don't require you to itemize your deductions. They simply reduce the amount of total taxable income on your Schedule E or Schedule C. Do your homework on exactly what deductions you can claim to minimize your tax bill, and as always, speak with an accountant to discuss any gray areas. Number 7. Take advantage of the 20% pass-through deduction. The Tax Cuts and Jobs Act of 2017 include an intriguing tax perk for small business owners, including real estate investors. On the simplest level, it allows small business owners to deduct an extra 20% off their net business income. Of course, nothing is simple with the IRS. The allowed deduction is the lesser of 1. Your combined qualified business income. 2. 20% of the excess of taxable income over the sum of any net capital gain. What exactly is combined qualified business income? For some types of businesses, there are income limitations in place like marital status. You can read the full IRS definition of qualified business income or save yourself the migraine and talk to your accountant about it. With a sharp accountant, you should be able to deduct an extra 20% of your real estate investing business income from your taxable income. Number 8. Depreciate your properties. Another paper expense real estate investors can take advantage of is depreciation. The IRS sets the lifespan of a residential building at 27.5 years, so the property owners can deduct 1/27.5 of their property's value each year for the first 27.5 years they own the property. For example, say you buy a property for $150,000, with the land valued at $50,000 and the building valued at $100,000. Each year for the next 27.5 years, you can deduct $3,636 for depreciation. You can also depreciate capital improvements to the property. For example, if you install a new roof for $8,000, that $8,000 can be depreciated over 27.5 years. That's the good news. The bad news is, when you sell the property, you'll owe taxes for depreciation recapture on all profits you had previously avoided paying taxes on through depreciation. Of course, if you never sell, you never owe those taxes. Number 9. Realize appreciation by borrowing, not selling. The property you bought for $150,000 appreciates over time, and after a few years, you would have built some equity in it. You could sell it and pay capital gain taxes on that equity, or you could borrow with the property and not pay any taxes on the cash in hand. In fact, you'd get to deduct the borrowing costs, both closing costs and mortgage interest. Over time, your tenants pay the loan off for you. You get to keep the property, which hopefully continues appreciating for you, and the rent rises with time, even as your mortgage payment remains fixed. And when the loan is paid off, guess what? You can turn around and borrow more cash with your property. Number 10. Hold your properties forever. If you die owning real estate, the original basis or acquisition cost disappears, and your heirs pay no capital gains. Your original basis for the property was $150,000. Let's say that over 30 years, it appreciates to $900,000. If you sell the property, you can expect to owe taxes on your capital gain of $750,000. Or you could keep pocketing the rent from the property every month and never sell it. If you want to pull out cash, you can borrow using the property, as mentioned before, or you could leave it unencumbered and earn that much more cash flow from it. When you die, the property passes to your heirs as part of your estate. They may owe estate taxes on it, but only if you died wealthy. The first $11.18 million of your estate is tax-free. Otherwise, they get to sell the property and keep the proceeds tax-free. We have reached the end of this video. Thank you for watching. Please visit us at www.itraining.nyc for more information.